Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today with Steve Penny, publisher and founder of the SilverChartist. And we'll definitely put the SilverChartist report link down below so you can follow along with Steve's analysis and the community that he has built over there. And Steve, it's been literally over a year since we've had you on the show, so it's great to get you back on to get your technical take on some of the markets our audience focuses on the most. We're going to kick things off with the gold chart, and we're going to go big picture to small here. We're going to go from the monthly to the weekly to the daily. When you take a look at this gold chart, you can see the large, I guess you would call it the cup and handle style or saucer shaped bottom, the big picture one and the small one. And obviously, over the last year, we didn't even get a chance to celebrate this, man. Gold
That's
exploded
right.
higher. It finally broke above that neckline, that 2080, had quite a rip up to 2800. How are you seeing things play out on the larger chart here on the monthly chart?
Yeah, thanks so much for having me back on, Chad. Certainly has been too long, and really enjoy connecting with you and your audience. You've got a really cool community yourself over here at Correlate Economics and all the things you're doing. So thanks for having me back. But yeah, from a big picture perspective, to me, the fundamentals for gold have never been more bullish. The thing though is that that is now being reflected, starting to be reflected in the price action. So to me, while I do think gold has a lot more upside potential, especially over the next, let's call it 5 years or so, the risk reward ratio diminishes as price moves up. So there is still upside potential, but to me, it's, over the short term, over the next couple of quarters, I think the risk reward ratio is about 1 to 1. In other words, the upside potential is about the same as downside risk. So I'm not really looking to chase gold here as a speculative trader or investor. However, physical metal stored outside of the banking system as an insurance policy, I think everyone should have it some exposure regardless of the price. So that's kind of where I see gold right now. And not to be too long winded of an answer, but last year at the very end of 2023, going into 2024, we were talking about this pattern here. And the way you get a measured move target out of a big pattern like this is a couple of ways you could do it. But the most conservative would be to take this portion of the handle and just flip it over. And that's pretty much exactly 500 bucks. So that gives you a target of $2,500. An equally valid way to do it would be to take this portion and flip it over, and that's a $1,000 move. That gives you a target up near $3,000. So we've been saying for the last year, 2,500 to 3,000 is our measured move target. Most recent high was 2801. So I'd say we hit that target pretty much squarely right in the middle, a little bit towards the upper edge, maybe a little bit more upside, but I don't see it moving that much higher over the short term, barring some kind of huge major extraneous event.
And maybe an upside ceiling, like you say, around 3,000. So that's not that far away from where we're even trading today. So a lot of the move has transpired here, but let's dive into the weekly chart and maybe get a little more granular on the charting. And I guess for people waiting for $5,000 gold, Steve, what would you say to those folks?
Well, I'd say I expect $5,000 gold and even higher in the fullness of time. I think it's going to take a couple years. Um, in the meantime, if you're willing to endure pullbacks to, 2,100, 2,200, something like that, I'd say, hey, just don't do anything. I think that's the best strategy is to just sit and wait and endure the volatility, scale in on weakness. And if you're so inclined, if you've got, a trading position, take profits on strength. But I think $5,000 gold is coming. In fact, if you just take an average of the previous two bull markets, the 1970s one, and then the one from 2000 to 2011, that gives you, in terms of total return, if you start the beginning of this bull market of January 2016, the average duration is about 10 years, and it's about a 10x increase. So, that gives you $10,000 gold or north thereof, in the fullness of time. That's not this year, but in the years ahead, I think.
Well, looking at this, it looks like you got the daily chart up of gold. There is a compression triangle where it looks like it is in the short term starting to whipsaw back and forth, but getting closer to that apex. It's still above the key moving average, but it's consolidating where it looks like it's going to make a hard break one way or the other. How are you looking at it?
Yeah, like right now, this is a pretty constructive pattern on the daily time frame here. Um, these kind of trends, when you get a clear triangle like this that's obvious, it tends to break in the direction of the prevailing trend, which is clearly up. So I'm looking for this to break out upwards, with the immediate profit target being the most recent high, 2801. Now, if we break above 2801, then the path of least resistance is further run up towards 3000. And I don't even rule out a run up towards maybe 3200 and change on the way upper end. But if you look at where it's at today, let's see. As of right now, 2687. Let's call it $2,700. Um, If you say the upside potential is 3,200, that's $500. That's really nice, but there's also downside risk of about 500. I don't want to rule that out. It wouldn't be out of the ordinary for, to pull back to $2,200 somewhere in there. That would still be, that would not invalidate the uptrend. We're anything, as long as we hold above 2,000, I'd say we're in an uptrend on the longer time frame. So risk reward ratio about 1 to 1. I think that's the key takeaway. Although I do think over the shorter term, this triangle pattern looks constructive. So if you're a real short-term trader, yeah, 2801 looks like a reasonable profit target over the next couple weeks.
Just as an aside, as you're pulling up the next chart, Steve, do you really use moving averages as far as a momentum tool, as far as if the chart is staying above the moving average and staying there in a I guess a more bullish posture? Is that something where you press your bets a little bit harder, or when it falls below a key moving average, do you get a little more tentative?
Yeah, so really good question. The longer I've been doing this, the less indicators I prefer on my charts. So right now, the only chart I put a moving average on is the daily. Weekly moving averages I've found to be less reliable. Same thing with monthly. So I don't even use them. So the one key one that I look at is the 200 daily moving average, the simple moving average on a daily chart, because I think that's the most widely used by these institutional trading algorithms and big money. Like anyone who looks at charts puts a 200-day moving average, so it can become like a self-fulfilling prophecy. To a lesser extent, the 50-day moving average on the daily chart. So those are really the only two that I use. And ideally, I like to buy on a pullback, oversold pullback to a rising 200-day moving average. To me, that's like the most favorable risk reward opportunity. If you can get RSI oversold right up to a rising 200-day moving average where price is right there, your downside risk to me is minimal. And what you can do is place a stop loss right below that 200-day so that if you're wrong, hey, you maybe lose just a little bit, but you've got a lot more upside potential. So that's a way I use that. That's one way I use those moving averages.
All right, I appreciate you weighing in on that just because we get a lot of discussions on different technical overlays and different things people use. And I agree with you. Sometimes I look at a chart and it's just an eyesore. There's so many different levels of it, and there's clouds on it, and these different trend lines, and there's forks, and there's so many things going on that it's hard to discern what's actually happening to price action when price is primary. Now, when we look at the silver weekly here, we didn't even get to celebrate silver getting above 30 and going to 35 last year, Steve. So we'll celebrate
Yeah.
it now, but we'll also put in the caveat that it's pulled back sharply since hitting that 3507. It looks like it's falling. It fell down into kind of a support zone. You're calling it an accumulation zone between 28 and 30. Give us your read on the silver weekly chart.
Yeah, I think there's going to come a day where silver breaks above 30, and I think we may be there right now, where you look back and you say you're never going to get to accumulate physical silver below $30 again. Like I think we might tell our children and grandchildren someday, hey, we bought silver for 20, under $30, and they almost won't believe you. I think that day is coming. So to me, $30 silver is almost like the equivalent of $2,000 gold. It's the major breakout level. So breaking above 30 was a big deal. And that was the key that unlocks these big measure move targets up towards, in the 40s and even $50 silver or even higher. So it's normal whenever you have a major breakout like that to come back and back test it. So far, that's all we're doing. It's a major breakout above 30, and now we're back testing that $30 level. So to me, any little dips below 30, down into 20 to 30, is an attractive spot to accumulate. Now, I don't rule out, because silver is so volatile, I like to say strategy is greater than prediction. So I make if-then statements, right? Takes the emotion out of things. If we get a deflationary impulse, a sharp pullback, 2640 would be the level that I really scale in aggressively. Like I take some of that opportunity fund capital that I reserve for like really the best buys and deploy that into silver if we get back to 2640. You can see the importance of this level right here. Not predicting that we pull back that far, but if we do, I think it could be prudent to keep some cash available. So, and that's such an important thing too. Not to digress, but I like to set myself up so that I'm content regardless of the short-term outcome and price. Like some people are only happy if silver goes up because they have no cash. So if you have some cash available, well, you're happy if silver runs up because you have a core position. But if it pulls back sharply, everyone else is like throwing in the towel. Well, you can be the beneficiary of that by having some opportunity funds available to scale in on weakness when everyone else is selling. So I'm happy whether silver runs up or runs down. Same with gold and uranium.
Yeah, I think it's such a great point that you want to have a position in your portfolio where you're happy to go either way. If it pulls back, you buy more. If it runs higher, you're happy that you have exposure. But when you're all in, it's hard to buy more on these dips. And I can see the trend line that you also have underneath on that silver weekly where it went from the 1740 back in 2022 where it dipped down. That's when gold dipped down to I think 1618 and then it's trended up and if silver were to pull back, it's kind of where it meets that lateral price support at 2640, that apex of that triangle there, it wouldn't be out of line for silver to do something like that and pull back there, and it'd be a great place to scale in. But on the bullish side, you've got that upper rail, that upper trend line, the trim profits line. Do you think it's possible it makes a run at that and gets up into the high 30s, maybe even the 40s this year?
I do. Yeah, I don't think it's not. I think it's not only possible. I think it's probable. Again, trying to avoid like predictions, especially tied to a timeline, but I think that's a reasonable possibility. Conditions are ripe for silver to continue to run. It's a totally reasonable expectation to see higher silver prices this year with the fundamental backdrop. And, let's face it, it's the only commodity on planet Earth that's trading below where it was 40 something years ago in 1980. So I think $50 silver has a magnet on it, to be honest. I'm surprised it hasn't gotten there already in the last couple of years. But anything below $50 silver, I think, is very cheap over the long term. And I think we're going to head to 50. And silver's so volatile, I have 50 as a target. That could be give or take $10 on either side. But I think somewhere around 50 is a magnet. I think ultimately, you fast forward a few years, I think $50 is going to be support. Um, People will be looking to buy the dip to $50 silver. I think that day's coming too. Not this year, but maybe the year after or the year after that.
Yeah, and it's very much like we're talking about $30 silver right now. $50 being the all-time high in 1980, and then again in 2011, the 49 to $50 range. So if silver does get there and then break above it decisively and hold above it for a period of time, it very much could be the case that those are the new support levels in the future. One step at a time, though, Steve.
Yeah.
Let's crawl before we walk here,
Yeah,
and let's walk
100%.
before we run. But just out of curiosity, is there a lot of overhead resistance between that $35 and 50? When I look at longer term charts and I go back further, I don't see there being a lot of other resistance zones. Maybe you have some of them marked on a longer chart. Okay, there you go.
I do. I mean, these aren't like super clear ones. What I do if there's not like clear patterns and like obvious resistance, like there's not like a big horizontal resistance line here, but you can just take like the cycle highs, the peaks, and those will probably serve as resistance. But it's not like it's major resistance. There's really no big major resistance till you get up here near 50.
Just wanted to cover that with you, but yeah, that 43, 44 zone, a couple peaks there where some long wicks on the candles may give some potential resistance. But that's the other thing with silver is that once it gets into that area, it's kind of rarefied air. There's not a ton
Yeah.
of resistance blocking it moving to that magnet, as you say. Um, I guess let's maybe pivot over to uh, some of the. I don't know what you have up next, but maybe some of the silver stocks or gold stocks would be good. GDX, yeah, that'd be a good one to dig into. As we know, over the last year or two, unfortunately, the stocks haven't matched the underlying metal stocks. They are different asset classes. These are still equities. And as a group, GDX has a big basket of stocks in there. Some of them, like Newmont and Barrick, have not done so well lately. So when you look at GDX, a lot different chart than the gold chart. How are you looking at it?
Yeah, I mean, there's no way to put lipstick on this pig. I mean, it's the performance of these mining stocks have been, very disappointing to put it lightly. We do own my two core positions in the big guys are Wheaton Precious Metals and Agnico Eagle. Those have both done exceptionally well. Wheaton Precious Metals has made, fresh new all-time highs as you would expect. It's performed as you might expect. Agnico Eagle, came right up to its previous all-time high. So, you would have expected with $2,500 gold, it would have made a new all-time high, but still it's performed very well, those two in particular. But you're right, GDX, it's mixed in with a lot of the dogs too. Uh, but I do think when that speculative fervor returns to the precious metal sector, which it has not yet, despite the price moving up to $2,800 in gold, people are going to look for that outsized return in the mining stocks. I still believe that's going to happen. And when I look at this long-term chart for GDX, I see a triangle pattern. We talked about a breakout and then a back test in silver. Well, we broke out from this downtrend line. This is a pretty clear downtrend line going back to 2011. And now we're just back testing it. Um, you know, I think GDX has more upside potential than downside risk. Kind of conversely to gold, gold, I said the risk reward ratio is probably somewhere about 1 to 1. I think GDX, it's a little bit more favorable. We did lose that support at the 200-day, and this was key support here, 36.26. You can kind of see that obvious line that coincided with the 200-day moving average. This was a really strong confluence of support right here. To be honest, I expected that to hold. But it fell. And when it fell sharply right down to the next support level of 33. Well, now we're rallying back. So if we can get back above this 200-day moving average and this horizontal resistance, that would make the technical picture look a lot better. However, if we kind of roll over here, we talked about breakout back test. Well, the same works in reverse. Break down, back test, and then fail. That would be an ugly looking chart if we went and made a lower low here. That's not my baseline expectation. If I had to, prognosticate, I would think we break through this 200-day moving average before too long, and this will look like a false breakdown, but only time will tell.
And that's another good example, Steve, of what we were talking about earlier with on the daily chart, using the 200-day moving average as a sentiment barometer. When it's below it, it's really a bearish posture to most people in the market. When it's above the 200-day moving average on a daily, that's really the line in the sand for a lot of professional traders, a lot of institutional traders. So it would be bullish for everybody if we saw it back above that 200-day moving average.
Yeah, there are a lot of fund managers, like I think of Paul Tudor Jones. They just don't touch stocks below their 200-day moving average. And there's a lot of big money that's like professionals have investment plans and trading rules, and it's common for one of their rules to be we don't buy stocks below their 200-day moving average. It's just not something you do. Because if you go back historically, like if you were to hold to that rule, statistically, historically, you do better. Your performance is better over long term just by avoiding them altogether. As a contrarian speculator, I don't have that as one of my rules, but I can see why people do that. So it is important to have that 200-day moving average and recognize when price is above or below it.
Well, and you can see it even on this chart when it broke above it in 2024 last year decisively. Look at all that time it spent ratcheting higher. So there's a prime example of a breakout above a 200-day moving average where it holds, and you can also see breakdowns where it's not so pretty, and some of that is because it's lost momentum to most traders. But interesting take on GDX. Let's hope it resolves on the bullish sense. But shifting over to the silver stocks, the beleaguered silver stocks, Steve. I know these are ones that we both are a fan of. I have a lot of silver stocks in my portfolio. I know you do as well, and I know a lot of people listening do. So when you look at this, not a pretty picture. It has broken down again below that 200-day moving average. It's trying to find support. It's actually bumping up against resistance right now. Walk us through what you see here for the silver stocks.
Yeah. Excuse me. If you've been disappointed with gold miners, you've been even more disappointed with silver miners. Unless you took profits. I don't want to say, hey, we played this perfectly and kind of pretend like I've nailed every top and bottom. But, at SilverChartist, we have used volatility to our advantage really well. I sold about 40% of my silver miners right here. I mean, I wasn't trying to hit the top tick of the day, but we got pretty darn close right here, that day that silver popped above 35. So that created cash available to buy on these pullbacks. Now, just like I was saying in GDX, that confluence of support, I scaled back in here to a rising 200-day moving average, thinking, hey, this is a fairly attractive entry point. But once that support gave way, boom, we fell sharply down to this next major support level at 1060. Well, if you look at this big down day here, it's kind of weird with SILJ, this particular ETF. For whatever reason, I kind of understand why they do it, but they have a 7% dividend, which really doesn't make sense because the underlying holdings, none of them, not a single one, pays a dividend anywhere near 7%. I think that's a way to get, a lot of fund managers will only buy things with a yield. But that's kind of like an artificial yield. So anyway, when they issued that 7% dividend, the ETF plunged by 9% that day, failing at this support too. So we got oversold, extreme oversold. RSI got down to 26. And now we're just testing what was support as resistance. So kind of like GDX is testing that 200-day from below. In the same way, SILJ is testing this 1060 level as resistance. My baseline expectation is that we get back above that, but strategy is greater than predictions. Having if-then statements is more valuable than any short-term predictions. But for what it's worth, I think we're going to get back above this, reclaim that 200-day moving average in the weeks ahead.
Well, and Steve, another thing about technical analysis is it's not fortune telling, it's not a crystal ball, but it tells you when there's probabilistic setups. So
Yeah.
you buying at the 200-day moving average as support was probabilistic that that's where it could have found support. Now it didn't, and it dove down below it, but
Yep.
the same kind of thing at the resistance line. So a break above it just sets the probabilities up for a better run higher. And same thing if it breaks above the 200-day moving average. So it's not that these are trying to predict the future. It's just looking for where do the trades setups have the best risk reward potential. Would you agree with that?
Yeah, I think that's very well said, and that's a very important point because a lot of people misuse technical analysis. They misuse charts. Yes, it does give you an edge in forecasting. However, it's maybe a slight edge. Maybe you can have like a 55%, accuracy rate with forecasting, which is good. That's a nice edge. That really matters. But 45% of the time you're going to be wrong. But to me, it allows me to manage risk, take emotion out of my trading, and it allows me to make if then statements. If then statements. If this happens, then I'll do this. So in other words, like if we rally up towards this profit taking line, then I will scale out and take profits, take partial profits. If we pull back to this support level and we're oversold, then I will scale back in. If then statements. And it kind of helps take the emotion out of it because I've got a plan. If this happens, then I'm going to do this using the chart as opposed to forecasting. Although, forecasting is a valuable tool. It's just not the end all be all. That's not really the main thing.
Yeah, I don't want to say that you can't use it to look at Fibonacci extension levels or where a trend line is going or where a channel is on some of these charts, but the main thing is to look for advantageous trade setups where you're stacking the odds in your favor. Uh,
Absolutely.
well, let's pivot over to a sector I know we both like, the uranium sector. Uh, I don't know if you want to start with the uranium price or if you want to start with the uranium miners. It looks like you got URNM pulled up here. Um,
Yeah. And I can pull up a chart for the futures price of uranium
Let's
if you
start
want
there
to.
then. Let's start with the uranium itself. It had that epic move up to 106, triple digit uranium. We've been waiting for it, and it has pulled back some since then. It's been a wild market because it's got so many factors tying in with nuclear power, tying in with the supply demand from uranium companies. But when you just look at the straight up uranium price, what are you seeing, Steve?
Yeah, so you mentioned something important again is, for me, when I speculate, I consider this sector a speculative sector. I like to say fundamentals tell me what to buy or what to sell, and technicals tell me when to buy and when to sell. So when speculating, I like to find a sector with extremely bullish fundamentals, and then I can use the technicals to kind of, guide my buying selling decisions. And as you mentioned, the fundamental case for uranium, like it's almost laughable just how bullish it is, and it seems to get more bullish by the day. Like before these AI data centers, there was still a structural supply deficit forecast going out for a long time, and the cure for that is much higher prices, and that remains to be the case. Only it's more true now than I think it's ever been. However, it's extremely volatile. Like if you're a silver mining stock investor, volatility, but I think uranium gives silver miners a good run for their money on, which is more volatile. I mean, these things are extremely volatile. Anyway, we got up to $100 uranium here, and this is where everyone was peak bullish. You heard on social media, everyone's talking about supply demand fundamentals and price, and all those things are true. However, I like to talk about those when those fundamentals are not reflected in the price, down here when no one's talking about it. That's when I like to talk about supply demand. So anyway, I sold a lot of my uranium up here, and to be honest, it was life change. It was the trade of my life. Uranium has been because I'm not afraid to push the sell button. And I didn't sell all of it. I still have some, but I sold well over half, the majority of my uranium. But now we're pulling back to, you can see this interim peak here that was 73. Well, now that's kind of support. And we had a little dip below that. This extreme overbought condition is now worked off. And, we're at a place where the risk reward ratio is extremely compelling. I'll just be honest, for me, like uranium, and I think you said you might agree, is my favorite speculation heading into 2025. Um, so I'm very, very favorable towards it, and I'm accumulating some of the ETFs pretty aggressively on weakness.
Well, Steve, I just want to give you a hat tip that I follow your service. I follow what you say to subscribers. And I remember you taking heat, not just on that sell, but on the prior peak before that, a couple of years before, where you mentioned hey, I'm going to lighten up some of my uranium stocks. And a lot of people went after you on your own site, your own subscribers. Steve, you don't believe anymore. You're not a true believer. And you're like, I'm just looking at the chart and saying it may be a good idea to take some profits. And those exact same people said, you were right, Steve. I probably should have taken some profits, but I was just all bulled up. And then when it pulled back down and everybody was throwing in the towel and saying, I give up on this sector, I forget about it, you would put out trade alerts to your subscribers and say, hey, I'm starting to accumulate some uranium stocks here. I'm starting to, buy individual stocks or the ETFs. Well, why would you want to buy this dog of a sector? It's a terrible sector, Steve. And then it would bounce back up and they'd say, oh man, I wish I would have, could have. So again, this is just, no one's a perfect trader and we've all made mistakes, but I just want to give you a hat tip that you were able to buy and sell uranium a couple different times that I've watched at good levels, maybe not the exact bottom or the exact top,
Sure.
but really good zones to be buying or selling. And I think that's how people make money in investing, not by falling in love with the sector. But tell us what you see on the URNM chart here. This is the Sprott. This is probably the largest Sprott fund. They have the URNJ as well, but this is the one that a lot of people track for uranium stocks.
Yeah, for sure. Like if I could only own one ticker in the uranium space, for me personally, it would probably be URNM or URNJ, the similar ETF, just junior miners, because you get exposure to the physical metal, the big names, Cameco, Kazatomprom, and some of the smaller, more speculative names all in one, and it's a quality run. The picks are pretty good. Anyway, um, if then statements, right? So that you can just see, you don't even have to know about technical analysis to just see. I mean, you can see anytime we pull back to this uptrend line, that's been a favorable entry point. You mentioned, back here in 2022, that's where we scaled out, not all of it, but some, and then scaled back in here when everyone hated it. Took a long time to get, for this consolidation and this weakness. And then we got the big breakout up to 100, or excuse me, $60 on URNM. And now we're back testing this line and everyone's frustrated. And I get it. I mean, it's been super frustrating with the bullish fundamentals, but price isn't being reflected. But that's, if you're a contrarian, this is the time to buy on oversold pullbacks to support. You can see this uptrend line. No guarantee that holds, but I think it's likely to hold. It's very likely to hold. Fundamentals suggest that, technicals suggest that. And when you zero in on the daily chart here for URNM, we're below a declining 50 and 200-day moving average. That's, that's not a good look. But I am somewhat encouraged by this island reversal we had a few months ago, where you gap down on big volume, consolidated, had this big gap up, leaving behind what they call an island. So often that marks a low. No indicator is perfect. You don't want to put all your bets on one, price pattern. But to me, that looks like an island reversal. And this $37 area, I think, is probably the low for this move. So I'm scaling in pretty aggressively on any pullbacks to this $37 area on URNM.
I
Uh,
want to jump in, Steve, while you have
yeah,
that
go for
chart
it.
still up. That I also would call a W-shaped double bottom, where it
Yep.
kind of makes that W, where it
Yeah.
goes from a high level and then up. And a lot of times those are strong bottoms. But now that pricing is getting close to this, I was looking at this chart on a weekend article I was writing over at Substack, and I'm getting concerned that it's getting back down near that. What would happen to you if that level were to break that $37? Just in a bearish scenario, if it just keeps in that
Yeah.
downward channel, what targets would that set up if that was to break?
Yeah. So targets it would set up would be, you've got this, I labeled this Best Buy accumulation line. So you can see this is very clear support. By the way, with technicals, to me, I rule out anything that's not obvious. I like to see draw lines that would just be obvious to anyone who does technical analysis. And here's one. I'm not expecting this to be tested, but if this Best Buy accumulation line is tested, then I'll scale in even more aggressively. But to me, they're cheap enough now where it looks good enough right here. But that if this were to fail, that's the question you asked. Well, then this becomes the next support, this accumulation line right here.
Yeah, and I want to put the caveat that I hope that does not happen as
Sure.
a person that has 10 uranium stocks in my portfolio, but also as someone that's looking at the technical. I think it'd be nice to see things rebound up to the upper end of that rail and then eventually make good on that 200-day moving average and get in a bullish posture. But I always like to look at the bullish and the bearish. And in the bearish scenario, you've got that Best Buy accumulation line as another area that you would scale in. Well, on the uranium side, we've talked silver, we've talked gold. Another component of investing that everybody should really follow is the US dollar. And we had talked before the call that we may just take a deep dive into the US dollar here just for an idea of what's happening. Now, there's not always an inverse correlation to commodities and the dollar, but more times than not, the dollar is a headwind, a rising dollar to commodities. And there's a lot of algos that are keyed off that, and a lot of traders that are professional traders that use that as an analogy. And a dropping dollar is actually usually a tailwind for the commodity sector, especially when you get into things like copper and zinc and aluminum and some of the base metals. So when you look at this dollar setup, I can't tell you, Steve, how many times we've had somebody on the show for years that's talking about the death of the dollar. The dollar's going to crash. The dollar's going to the 90s, then the 80s. And when you look at that channel that you've laid out here, really from 2010 forward, it's actually been an uptrending US dollar channel. It hasn't been a downtrending. The dollar has not had the demise. It has not died yet. It's actually been going higher than most people expected. Even recently, last year and this year, it's gotten above short-term levels that people expected. So when you look at the dollar, I guess from a longer standpoint, from a decades perspective, it is stepping down. But how are you looking at it within this channel? And you've got a potential path drawn out there. How are you looking at what could happen with the dollar?
Yeah, I did lay out this potential path, and I agree with everything you just said. I think you articulated it perfectly. I look at the dollar as either a headwind or a tailwind. Sometimes things can go into the wind and still move forward. In other words, commodities can rise with a rising dollar. But it's a tailwind when it's falling. So anyway, you go back to 1980 and you've got lower highs. So that's certainly, you can make a case, lower highs, lower lows, that's a downtrend. But if you zoom in a little bit more to this 2007 low, well, then it has been an uptrend, higher highs and higher lows. Now, don't take this with a grain of salt. I don't like to give forecasts and predictions because then people take it too far, and I don't want people to misallocate their money based on some guy on the internet's prediction. You know me, um, but I can see this as a reasonable scenario. Is the dollar weakens over the intermediate term here, short to intermediate term, that coincides with these big profit taking opportunities that we've been looking for. Something like $50 silver, 3,000 plus gold, a nice move in uranium, copper, as the dollar weakens down to the lower edge of this support, maybe even a false breakdown. And then something breaks. I mean, we've just had the most rapid rise in interest rates going since the Federal Reserve's inception in 1913. And interest rate moves operate with a lag. People call it the lag effect. And we haven't really seen any detrimental impacts of the fastest rate increase campaign in Fed history. And I think that because it hasn't happened yet doesn't mean it's not coming. So where am I going with that? I think something's going to break at some point due to these high interest rates, which, by the way, they're still elevated despite the Fed cutting. The 10 years up at almost 5% right now, which I think is very likely to break something. So when something breaks, we're likely to get a deflationary impulse where everything sells off, especially risk assets, and the dollar rises. And I could totally see the dollar rising up towards the upper rail of this channel, maybe even higher than 120. Before the Fed does what the Fed always does, step in with quantitative easing, debt monetization, currency creation on steroids like we've never seen before. And that probably coincides with a really sharp pullback in the dollar. And that's where we see the super high prices in silver and gold that you'll see talked about, the six triple digit silver, things like that. That's premature to talk about that now, but I think many of us agree that's coming. Would be the Fed's response to the next deflationary impulse. I know that's a lot of words. Hopefully I articulated that succinctly, but to sum it up shortly, weakening dollar, rise in commodities, profit-taking opportunity, something breaks, a deflationary impulse, rise in the dollar, followed by Fed response, QE on steroids. That's kind of my baseline forecast.
Just as a alternate path, is it possible that when the dollar falls and it gets to the bottom of that channel, let's just say by 2026, 2027, just as a rough idea here, that it just keeps dropping? Could the dollar bears be correct that we never really get that recovery and that blast higher? Maybe things just keep dropping. What kind of an environment would allow the dollar to keep dropping earlier than anticipated?
Yeah, that's a really good point. It's possible. It's not my baseline expectation. I don't think it's probable. But I think that would require the Fed to be proactive as opposed to reactive. Historically, they've always been reactive. They react to the deflationary impulse, they react to the crash. But perhaps if you want to just speculate and have some fun here, I mean, you can make that case. Here's how I would make that case. Dollar weakens, and like inflation benefits debtors and it hurts creditors. So who's the biggest debtor in the whole world? It's the U.S. government. So they benefit from inflation because it devalues their debt. They owe back their debt in deflated dollars or inflated dollars, I should say. So you can make a case that there's some kind of revaluation. I know like Luke Roman and people like that are talking about, how the Fed or the government needs to reflate or devalue the dollar. So if there's some kind of formal devaluation of the dollar, um, that I think that's within the realm of possibility, and that could maybe forestall or avoid this deflationary impulse and just have the dollar continue, go straight lower from here. Um, but I'll just, since we're going down this thought experiment, I'll throw this out there. If they were to do that, obviously gold, silver, things like that would skyrocket. Oil, I think, be careful what you wish for, because with something like that, I think it would likely come with some kind of windfall profits tax on your capital gains in those sectors. But these are all. This is just fun to speculate about and think about. But um, the bottom line is set yourself up in a way to be prepared for a variety of different outcomes.
Yeah, and that's the only reason I wanted to ask, just as a thought experiment, like you said. And there are a lot of people that are anticipating that, Steve. I listen to investors and I read them online that are waiting for the dollar to crash and for gold and silver and oil and everything to go to the moon. But like you say, be careful what you wish for. Now, I think that one of the benefits you bring to your subscribers is a grounding in the fundamentals, but also the technical analysis gives you, like you say, the fundamentals tell you what to buy and the technicals tell you when to buy, the favorable setups. I want you to maybe speak for a minute or two, just for people listening in, about what you offer people over at the SilverChartist community. You've built quite a community there. I try to check it out a couple of times a week for sure. And sometimes I'm on there every day if there's an engaging discussion or a nice debate going back and forth. You've got a partner, Jerry Robinson, that's been helping you out over there, putting out some, I think, great content. But maybe just speak to while you cover gold, silver, and uranium, you do look at other sectors. You do look at dividend paying stocks and how to be financially free and paying down debt and just a lot of different concepts that I think make people not just better investors but better human beings. So take a minute and just tell us what you do over at SilverChartist.
Sure. Yeah. Thanks for that opportunity. Yeah. It's a fully transparent over the shoulder service with real time alerts. So I share in a transparent fashion what I'm doing with my own portfolio. Not that you should just copy me, but I think hopefully that helps people make better decisions. But yeah, like I am wildly bullish on gold and silver. But a lot of people in our camp, they put all their eggs in that basket, and there are other opportunities. And at the end of the day, why are we doing this? It's because we want financial independence. And I think what that really means is we want time freedom. We want time freedom to do the things we're called to in life, to spend with our family. And to me, having building income streams, income investing is a key part of that for me. And that's where I like the investing for dividends, because there's a lot of talk about passive income. Well, very few things are actually passive income. I'd say dividend investing is one of those very small things that are. There are companies out there that are actually cheap or undervalued, I should say, and oversold, that will pay you a nice yield and that have increased their dividend for decades, and creating a growing income stream for you. People call it dividend snowball. So anyway, that's another thing I really like doing in addition to silver and gold. Sometimes people get confused. They're like, how could you buy a dividend stock when everything's going to crash next week? Well, I think there's room for both in the portfolio. So that's my thoughts on that.
Well, I definitely appreciate all of the different content that you provide to your subscribers. It's a community that I think asks good questions. I think sometimes the questions actually cause you to react to that and say, okay, well, here's my thoughts on that. And so it's an engaging community, but it's also, I've seen you do a lot more right than wrong. And I can't say that about every platform. There's a lot of platforms that really made some crazy calls and they're paying for it. And I think that the reason you've kept such a nice subscriber base is because you've been fairly accurate in how you were looking at short and medium term calls. Not everybody's going to be a winner. Not every call is a winner, but a lot of good content there. And I encourage people to at least click on the link and check out SilverChartist community. Steve, it's been great to have you back on the show after over a year, man. But at least we got to celebrate the breakouts in gold and silver on this call. And I hope that the charts we provided and that you dove in on gave listeners and viewers here some food for thought as far some probable setups and maybe where some of the future trades could come in. So appreciate you having you back on the KE report. Hopefully more times to come in 2025, and looking forward to our next conversation.
All right. Thanks, brother. Appreciate you.